Hello, everyone. I'm Miles. Before we dive into all the financial engineering around optimal capital structure, there's a core principle in corporate finance, the Modigliani and Miller, or proposition I. In a capital market with no taxes and free borrowing, the value of a company, that is the sum of its equity and debt market values, is independent of its capital structure. No matter how much debt you take on or how many shares you issue to support your operations, the total value of the company stays the same. V equals D plus E, which equals EBIT divided by the cost of capital A. The traditional view is that debt is cheap and equity is expensive, so adding debt can initially lower the weighted average cost of capital. But if you take on too much debt, bankruptcy risk rises and WACC actually goes up, making WACC a U-shaped curve. This suggests there's an optimal mix and companies can create value through their capital structure. Overturned this logic. In a perfect market, if leverage could really lower WACC and increase value, investors could just replicate it themselves, and arbitrage would immediately wipe out any advantage. So simply adjusting the capital structure can't lower WACC. WACC isn't a financing trick. It's the required rate of return for the asset. Adding leverage just redistributes risk, doesn't reduce the total amount of risk. Now, let's solve it to learn. Company A has a perpetual EBIT of 2,000, an asset return rate RA of 10%, a debt interest rate RD of 5%, and operates in a tax-free, perfectly competitive capital market with complete borrowing freedom. Question 1. What is the value of the company, V? According to the perpetual geometric series, V equals 2,000 divided by 0.10, which is 20,000. The method of financing doesn't change the asset return rate, RA, or the company's WACC. Question 2. If the debt is 8,000 or 4,000, how does A's cost of equity change? In a tax-free, perfectly competitive capital market, the first proposition holds, so RE equals RA plus D over E times RA minus RD. If there is no debt, RE equals RA, which is 0.1. In scenario 1, D equals 8,000, so E equals V minus D, which is 12,000. D over E equals 0.667, and RE equals 0.133. In scenario 2, D equals 4,000, E equals 16,000, D over E equals 0.25, and RE equals 0.1125. Equity becomes safer, the required return decreases, but WACC equals RA, which is 0.1, and it never changes. Leverage only changes who bears the risk. It doesn't change the risk itself. Question 3. If the market mistakenly values company L at 22,000, and given that debt D equals 4,000, then equity E equals 18,000. However, the market value of the unleveraged company U is still 20,000. How can investors use homemade leverage to arbitrage? The equity value of L is only 16,000, so L is overvalued. Step 1. Short sell. Short sell 10% of L company's equity and receive $1,800 in cash. Step 2. Go long and hedge. Use $2,000 to buy 10% of U company's equity and at the same time borrow $400 personally to simulate L company's debt. As a result, you immediately lock in a risk-free net profit of $200, $1,800 minus $2,000 plus $400. At the same time, the future EBIT and cash flows of this long position will perfectly match and offset the future liabilities from the short position in L company, achieving a complete hedge. Therefore, the total value of L must fall back to 20,000. Capital structure seems important because it repackages risk. But in MM's perfect and tax-free market, leverage can only change the cost of equity and the distribution of risk, but it can never change the risk of the assets or the value of the company.